Over the past year, international capital flow data show a net $48 billion in outflows from US markets, while BlackRock has adjusted more than $2 trillion away from a US-centered focus. This is not a forecast. These figures have already appeared in asset allocation reports. As the dollar weakens, capital repositions, and gold and silver are reclassified within the banking system. The question is your money being valued under the old rules or under the new ones? If you had been inside an institutional trading room over the past few weeks, the first sensation would not have been panic, but a heavy concentration. The screens were still on, the charts still flickered, but the urgent calls and the dense bursts of buy and sell orders were no longer there. Instead, allocation schedules were reopened, risk models were rerun, and brief, low technical exchanges took place. No one spoke loudly. No one needed to. Because at this level, everyone understands. When the allocation schedule changes, the story began long before. This is the real backdrop to the figures mentioned at the outset. It is not a dramatic withdrawal of capital, but a sequence of adjustments unfolding in parallel across many desks, many regions, and many time zones. When BlackRock adjusts the focus of its portfolio, it is not a single decision, but the result of a series of accumulated signals. Real yields declining, the cost of capital rising, and policy uncertainty no longer treated as temporary. In large allocation models, the question is never what will happen if the worst case scenario happens, but rather how much has the probability of that scenario changed. And in the current period, many assumptions once regarded as stable are being adjusted slightly, but simultaneously. When these small adjustments compound, they create movement large enough for capital flows to respond. What is difficult for a general audience to feel is the true tempo of money. It does not run, it does not jolt, it slides, slowly, evenly, and continuously. Capital does not leave the US market in a single day. Rather, quarter by quarter, the weighting changes. Report by report, priorities shift. And only when looking back do people realize they are standing in a different place than they were a few years ago. Meanwhile, the US dollar begins to reflect the pressure of prolonged fiscal policy and a changing interest rate environment. This is not a collapse, but a process of relative erosion. For global institutions, that erosion is enough to change the allocation calculation. When holding dollar-denominated assets no longer provides an absolute advantage, expanding into other currencies is not a choice of viewpoint, but a step in risk management. At this point, imagine capital flows as water in a canal system. When pressure rises in one segment, the water does not disappear. It finds another path. And those paths often lie in markets with different growth structures, younger populations, room for industrialization, and the ability to benefit from shifts in global value chains. Not because these markets are safer, but because, in probability models, they are being repriced. Politics makes this process more sensitive. No specific decision needs to be issued. As long as policy opacity persists, the cost of risk has already risen. In institutional models, that opacity is converted into a number, and that number directly affects allocation decisions. This is the point money cycles always emphasizes. Markets do not fear volatility. Markets fear volatility that cannot be quantified. In such an environment, the role of defensive assets is reconsidered through a different lens. Not by asking, how much will the price rise, but by asking, how do they operate within the system? When gold is reclassified with a higher liquidity role on bank balance sheets, it steps out of its symbolic role. It becomes a technical instrument that can be used to optimize capital structure and manage risk. This happens very quietly. There is no public press release. But in finance, it is recorded as a mechanical change. And whenever the mechanism changes, the market needs time to adjust perception. In that process, silver often reflects the change more slowly, because it sits at the intersection of a defensive asset and an industrial metal. But this intersection is precisely what makes silver an interesting indicator in periods of systemic strain. If we step back and look wider, we see this is not a new story. Financial history is full of periods in which money moved ahead of awareness. When the British pound gradually lost its position, there was no officially declared moment. When the US dollar rose, there was also no clear day of handover. There were only small adjustments accumulated over time until a new order became obvious. The common feature of those periods is prolonged public confusion. The news conflicts. Opinions diverge. Prices fluctuate, but do not yet reflect everything. And in that grey interval, large capital acts. Not because it is certain, but because it does not need certainty. It only needs probability. This is the middle zone that Money Cycles focuses on analysing. Not the peak of euphoria, and not yet the bottom of crisis, but a transition in which old assumptions are being tested, but not yet discarded. This is also the phase most likely to confuse viewers, because the surface of the market does not convey the whole story. In this middle zone, viewers are often pulled back and forth by headlines, by extreme forecasts, and by confident claims. But if you change the angle, observe allocation behaviour rather than argue through words, another picture appears. Not too loud, not too dramatic, but consistent. The system is adjusting itself to adapt. The real value this content provides is not in giving an answer, but in helping viewers recognise where they are standing. When viewers understand that big changes often unfold slowly and quietly, they react less to short-term volatility. Instead, they begin to observe more systematically, ask better questions, and avoid being carried by the market's emotional rhythm. That is also the signature the channel pursues. It does not promise the future, and it does not draw certain scenarios. It only places public data, historical precedent, and capital flow behaviour side by side. When viewers get used to this lens, they do not just watch one video. They return many times, because they realise they are being given a framework of thought, not a recommendation. And after following to this point, the natural question is no longer, will the price rise or fall, but, in a system that is adjusting, what have we been treating as self-evident for too long? It is precisely those seemingly self-evident things that must be examined most carefully in the present period. And this is exactly why this shift matters more than what the market surface shows. When large capital adjusts in silence, when politics increases economic uncertainty, and when gold and silver are redefined within the monetary system, we are not only witnessing an investment cycle, but a phase of reordering in the value hierarchy. Monetary history shows each time financial power shifts, purchasing power does not vanish. It only changes its place of shelter. This does not mean an extreme scenario is about to occur, but it shows why understanding system structure matters more than chasing short-term price. And this may only be the beginning. In the coming quarters, as policy, technology and capital continue to collide, the picture will become clearer, not through declarations, but through behaviour. How do you think this repositioning will affect the roles of the dollar, foreign currencies, and defensive assets over the next decade? Your perspective is worth discussing. This is Money Cycles. We do not chase headlines. We track the movements beneath them. And if you want to know what is forming next, you know where to find us.